Hey everyone, this is Corey with Sims Investment Management. This is another monthly market update. And first I want to say hoo-day. Hoo-day to all our Bengals fans. The Queen City behind me in the picture. I know we have a lot of clients in other states. Hopefully you will also be cheering on our Bengals this weekend. It's super exciting around the city just to see the unity that this has brought a lot of the city together cheering on the Bengals. So really hoping that we'll be bringing home our first Super Bowl here in just a few days. I'm going to jump right into the fact that in January we had a downturn. We had a little bit of a pullback, right? So we ended up hitting about 10% in a intraday decline on the S&P 500. The S&P 500 again being the 500 best, greatest companies arguably in the world. And we started to get some phone calls and some emails about this, which is ironic considering our January video we talked about this vitamin C, that the body doesn't retain vitamin C, and so we need it daily. And it seems to be that monthly message that we need, that market volatility is movements in the market up and down, and it's all normal. We were up 28% last year in 2021, and for us to have some heightened volatility in January and give some of that back as some of the data was coming out about inflation is completely normal. So to put that in simple terms, equities get you about 10% per year on average in the past 100 years. And in order to get that 10% per year in any given year, we might be up 20% or down 20%, but you can't have one without the other. And so when you're starting to feel that panic, a lot of times it's like, well, we need to ask ourselves, why are we feeling this? Why do we feel like we need to respond or react to this when all the evidence points to the contrary, right? History and time is on our side. So keep that in mind. To give you just further confidence in where we are, I'm going to read off some statistics. So when we look at earnings in the stock market, the S&P 500, these great companies are driven by earnings. So if you think about if you were going to go invest in a business down the street, you would probably rather invest in a small business that you were going to own that makes money versus one that doesn't make money, right? And so earnings projections for this year range anywhere from 9% to large companies to up 30% for small companies. So it looks like we're going to have a really good year in earnings, which should help continue to boost the market higher. In addition to that, the S&P 500, okay, those 500 great companies had at the end of the third quarter last year, they had $2.4 trillion in cash. And that's up from $1.6 trillion at the end of the third quarter in 2019. In addition to that, if you look at how much these companies are making in earnings versus their debt, so a lot of people are saying, yeah, they have a lot of cash, but they also have more debt. This is true, but their balance sheets are still stronger if we look at like any point in the past 40 to 50 years. So what they're making in earnings versus their debt is right around 1. So their earnings could pay for their debt on average in 1 year. If you look at like 2007 before the Great Recession, that was 4. So we're significantly better positioned for any type of market turmoil right now than we have been in the past. If you look at the individual consumer, our debt payments as a percentage of our disposable income is only at about 9% right now, which is a 40-year low. So it's really hard to find a better time when corporations and the consumer have been positioned. Yes, we have more government debt, but you could argue, is it better for us to have more government debt and have corporations and individuals stronger, or vice versa? I personally think having more government debt is better as long as the consumer and the business is better off. I've got a couple really good quotes in this month's newsletter, so I hope you take the time to read it. I did kind of change the format this month and just try to provide some quick hitters. I've got some good attachments on just historical trends in the market, intra-year declines, things like that. A couple other articles, and I'm going to attach some things just in regards to ARK, ARKK, which is a really common investment vehicle right now that's gotten a lot of attraction and why it's not the smartest way to invest. So companies like Zoom and DraftKings and things like that have been really popular, AMC, GameStop, right? Very, very popular in the media. But again, go back to that concept of if they don't make money, and if you were buying your own small business, would you go down the street and necessarily buy a business that continued to lose money? Probably not. So that's it for this month. If you have questions, let me know. There's some other really good resources about just some positive news from the past year that hopefully you can share with some of your loved ones and friends as well. We'll see you next month, and hoo day!